Thank you so much for taking the time today to work on your finances with me. I'm very happy to share some information on ESPP and how to manage your ESPP. So let's get right into it. Now, the whole reason we look at our finances, of course, is to have a good financial life. You're going to have a financial life no matter what, whether you take charge of it and act appropriately or in your best interest or not. You're going to experience some sort of financial life during the rest of your normal life. And there's two different outcomes that are possible. Door number one and door number two. Door number one is you're able to afford to do everything you want in life. Door number two is that you're not able to afford. Those are the only choices. So you will have a financial life. And whether or not you're able to afford everything you want depends on a lot of things. There's no guarantee of making this work. But without the process of planning and taking charge of this on your own or with some help, your chances of door number two go up considerably. So a great way to improve the chance that you get to do everything you want is to actually put some effort into your financial plan. So what do I mean by financial plan? Well, if you want to live your best financial life, there's 4 areas that feed into this. Protect what you have. That's insurance, estate planning, those sorts of things. Make good decisions there. Number 2, know where it goes. That's your spending. Where's your money going? Realize that your money is or is not being spent in alignment with your values and what you truly want. And so understanding where your money goes will help you align those things. Number 3, make it grow. That's investments. We all are concerned about our investments. It's what we think about. It's the number one thing that comes to mind when we think of finances, but it's really just a small part. It's the engine that makes everything work, but you've got to have the whole car built around it, which is all these other things. And then the 4th area is to retain independence and dignity. In other words, we're not going to live off our kids in retirement. We're going to make decisions today in the context of how they affect us in our 60s, 70s, and 80s. Not just investment decisions, but spending decisions, insurance decisions, estate planning decisions, all financial decisions. We're going to think about not just how they affect us today, but how they might affect us throughout our entire life. Now, I mentioned that investments is what everybody wants to talk about, but look at this. This is my process. And I wanted to show you how far down the list investment strategy really is. We don't talk about investment strategy until we do a lot of other things. Like, for example, well, we got to keep it on the right page. But for example, look at this item up number 1. Where do you want to go? That's the most important thing. If you don't know where you want to go, and you don't have to know it, by definition and be married to that choice. But if you don't have something to shoot for, it's really hard to build a portfolio that's right for you. And you're going to make mistakes that are bigger than if you have a target to shoot for. So just wanted to highlight that the investments are important, but they're not the only thing. Okay, what we're talking about today, what is an ESPP? We're going to talk through that. Why should you have a process to sell your company stock? Not just the ESPP, but your company stock. And then I'm going to provide a tax smart way to think about how you transition your company stock into the rest of your financial life. So let's get into it. ESPP stands for Employee Stock Purchase Plan. This is only for employees of a company, not for contractors. And it's a plan. It's a plan that your company, if they provide this, they give you the right to buy stock in the company. You don't pay any commission, and they just deduct money from your paycheck to do it. Now, they don't do it every single time. What they do is there's an offering period during which they deduct from your paycheck. That money builds up, and then on the purchase date, stock is actually bought in your name at an account at either E-Trade or Morgan Stanley or wherever. Now, companies can offer you a discount. Not all of them do, but more than likely you get a discount to buy the stock. The maximum discount they can offer is 15%. So if you get a 15% discount, guess what? That's free money, because that's stock that you buy today at a 15% discount, and you can sell it today or tomorrow. Sometimes it takes a day to settle into your account, but you can sell it fairly immediately and keep the extra 15%. Free money. We like free money. Now, there's also often a look back feature on that 15%, which means it's not just the 15% off of whatever the price is on the purchase date, but it might be the 15% off of a previous date. In other words, a lower price than a previous date. It's never a higher price. You're never going to lose money. And so let me work through an example to show you how this works. Let's take an example number one there at the top, that the stock prices rises. So let's say you enroll in the ESPP today, stock price is $100. Over the next 6 months, they're deducting money from your paycheck. That's building up in an account somewhere. Actually, the company holds on to it. And then 6 months from now on the purchase date, the stock is actually purchased. Now, let's say the stock price went up here in example one from $100 to $120. Well, you now have stock that's worth $120. What did you pay for? If you got that 15% discount, and if there's a look back feature, then you paid 15% off of the $100. It's the lower of the 100 or the 120, the beginning or the end period. So you paid $85 for stock that's worth 120 bucks. That's free money, right? Why would you not do that? You want to max that out and get all the free money you can. So great, that's great. When the stock price goes up, you make money. What about when the stock price falls? Well, you enroll today, stock price is 100 bucks. 6 months goes by, they're withdrawing from your paycheck, and the stock is now $80. And so you buy at $80. What happens then? Well, if you get the 15% discount, then you get 15% off the lower of 80 or 100. So you get 15% off of 80. So you're paying $68 now for something that's worth 80. Not as good as example one, but still free money. So we like free money. This is a great way to get free money. If you can afford to put off those payments for 6 months, put off that income for 6 months, max this out, get your free money. Now you're going to pay tax on this. So let's talk about that. The tax treatment that you get on that gain is going to depend on exactly what you do next. So in order to get, a lot of people will say you should hold on to the stock in order to get long-term capital gains treatment. We're going to talk about whether or not that's a good idea or not. But right now, I just want to talk about how it's taxed. So here's the way it works. In order to get the long-term capital gains treatment, you have to hold it 2 years from the start of the offering and 1 year from the purchase. So it's not just 1 year from the purchase. It's going to be at least 2 years from the start of the offering. So it could be 18 months from the offering. It could be 2 full years. Depends on exactly how your plan is structured. If you sell before that period, before either one of those, then you get taxed at ordinary income on a portion of it. And on a portion of it is short-term capital gains, which is also ordinary income. So if you sell before, you basically get taxed as ordinary income as if it's part of your paycheck. That's still good. You still got free money. You still netted free money after tax. You just didn't get the best tax treatment. So what's the best tax treatment? It's if you sell after both of those items. If you sell after them, then the discount versus the offering price at the beginning is taxed at ordinary income. So usually that's going to be the lower amount. And then the rest is taxed at long-term capital gains. So what does all that mean? Well, if you sell immediately and you pay ordinary income, you're probably paying somewhere between 24, 37%, somewhere in there, depending on how much money you make, what tax bracket you're in. That's the tax rate that you're paying on a federal basis. Now, in exchange for paying that immediately, you have no stock risk, right? You get the free money. It happens in your account today. You take it out of the account today. You don't have to worry about the stock going up or down. You're now contributing for the next 6-month period and getting the discount for that. Excuse me. All right. Let's say you hold the stock for the year and a half period. Well, if the stock goes up, then you're taxed at the discount portion based on the beginning price is taxed at ordinary tax rates, and the higher portion, the top portion, meaning whatever gains after you bought it, is taxed at long-term capital gains. That's about 15 to 24%. Well, look at this. If your ordinary tax rate is 24 to 37 and your capital gains is 15 to 24, what are we talking about is the difference in taxes? It's about 9 to 13%. It's about 10, 12, 13%, somewhere in there, right? That's the gain that you're hoping to get by waiting for long-term capital gains treatment. Now, what do you have to do in order to get that? You have to hold the stock for a year to a year and a half. So look at this question here at the bottom and think about it. What is the probability that your stock could fall by that 9 and 13% gain that you're hoping to get during the year that you have to hold it? And it may be even 18 months that you have to hold it. My guess is the probability is pretty high. So there's a really good chance that you could be going after this, squeezing this extra gain by going for the long-term capital gains and lose it and lose even more by having the stock drop. So why take that risk? I say for the most part, just sell it. But of course, it depends on your exact situation. And we're going to talk about that a little bit right now. As soon as we're going to talk about that right now. All right, so here we go. Excuse me. So let's take an example here. This is my buddy Fred Flintstone. I don't have his name up there, but my example is I always try to use Hanna-Barbera characters. So we'll use Fred Flintstone. Fred Flintstone, here's what he has. He has company stock that's about 20% of his assets. He's got about 10% of his assets in savings. That's good. Maybe that's his emergency fund. He's got 30% in his 401k. And he's got 40% in his house, right? If we own a house, that's always most likely going to be a big part of our pie chart. So here's the question. Are you comfortable, or should Fred be comfortable with 20% of his assets being tied to his company stock? Now, remember, his income is also tied to his company stock. So I'm just think about that. Think about what your gut tells you. And then I'm going to make the question a little bit more complex. And here's the deal. This house portion, this 40%, what we're talking about is the assets that you can use to pay your bills, right? But you can't use your house to pay your bills. Of course, I guess you could take out a bigger mortgage, or there's ways you could do that, but we don't really want to be in that position. So I would say that we really need to take this house out of the equation. So this is a total asset chart. What I think we should look at is a financial asset chart. Take the house out. So here we go. Same situation, same Fred Flintstone. All we did was take out the house. So now if we take out the house, a third of his financial assets are in the company stock, 17% are in savings, and 50% is in the 401k. So let me ask you this question. Are you comfortable, or should Fred be comfortable with a third of his assets in company stock while at the same time his income comes from the same company? I think you might be getting a little bit less comfortable. But I'm not done yet, because this 401k, we're not going to spend that. We're not going to use that on our current bills. We're going to save that for retirement. So really, that's not available to us either. So let's look at liquid assets, liquid financial assets. Now, all we have now is company stock and savings. And now company stock is 2/3 of our liquid assets. I think we'd all be pretty uncomfortable thinking that 2/3 of the money we have to pay our bills is tied to our employer, while at the same time our paycheck is tied to our employer. So very, very undiversified situation. Now, this is a bit of an extreme example, but you could do these calculations for yourself if you're not already doing them. And I suggest you take a look at that and think about it, because this will tell you your exposure, and your gut, 9 times out of 10, what I find is your gut will give you the right answer on what to do there. So, all right, let's talk about a tax smart way to make the transition from company stock into your long-term portfolio. Now, I've got other webinars that talk about how to structure the long-term portfolio and other things, but we're just talking about making that transition. How do we decide what to sell and how much to sell? So here's the deal. Our objective, let's get really clear about our objective. Our objective here is to reduce exposure to company stock while minimizing or spreading the tax cost over time. Now, you may not want to spread it over multiple years. If you're okay taking the entire tax hit in 1 year, great. Sell it, take the tax hit, make the transition. Now you're diversified. You're in a much stronger position. But if you've let this build up through your career, 7, 8, 10 years, you may have a large sum of stock, and it may be a little bit too much and maybe a little too painful to take that tax hit all in 1 year. And you may want to do it over multiple years. So that's what we're talking about. If we're doing it over multiple years, how do we do it? Here's what I do. First, calculate the tax cost of each lot of stock you own. Now, what do I mean by lot? I mean each vesting date, not each award and not each year, but every vesting date, because every time you vested, you were taxed at some level, and you have capital gains after that or losses, and they're either short-term or long-term. So we have to look at it by vesting date. Now that could be a big spreadsheet, because if you haven't sold your stock over 10 years, you got a lot of vestings. We want to look at that tax cost. And by tax cost, I mean, how much are you going to have to pay in tax if you sell it today? So we're going to look at that tax cost as a percentage of the value in each lot. So we're going to say, oh, if I have $10,000 in this lot, but if I sell it, I owe $1,000 in tax, then that means your tax cost is 10%. Whereas you might have another lot where you have $20,000 in value, but the tax is $10,000. Now the tax cost is 50%. You see how it's different? So we want to know how much tax cost we have by lot. Then we simply sell from the lowest tax cost to the highest tax cost. Now, why do we do that? Well, remember that 10% tax cost lot? We can sell that $10,000, get $10,000 out of our company stock, pay $1,000 in tax, get $9,000 into our long-term portfolio. That's 90% of the proceeds over there, and we've made good progress there. Whereas versus the 50% lot, we're not going to get as much over into our long-term portfolio, so we want to hold off on that. So here's how this might work here at the bottom. In year one, if you have $100,000 in stock, in year one you might sell $50,000 in stock and have a $10,000 tax cost. In year two, you might have to sell $30,000 to get to a $10,000 tax cost. See, same tax cost, you spread it out over the 3 years, but you're getting your money out quicker because you're selling that higher tax cost lot first. All right, hopefully that makes sense. If not, again, please put your questions into the chat or into the Q&A. We've got 2 minutes left here, and then I'm going to stay on as long as it takes to answer all your questions. So that's all great. That's Fred Flintstone. That's all that stuff. But what about you? Well, here's what's going to happen. Tomorrow, you're going to get an email with the link to the replay of this video and a link to download these slides. Take a look at them. Consider whether your plan of managing your company stock is right for you, whether or not you might need to sell a little faster, or maybe you're okay holding on. I don't know. But whatever the case is, and then schedule a call with me. Because you registered for this and because you're attending this session, I'm offering you a free coaching session that I normally charge $300 worth, so $300 value, to walk through your results and to attack this challenge. So all you have to do is schedule that with me. And if you want to go ahead and do that, I am going to put the link in. Let's see if I get the right link. Got to make sure I get the right link. I'm going to put the link here in the chat so that you can go ahead and click on it and schedule your time and do your homework, whatever you want. Let's see. Oh, there we go. There's the link. You can click on that link, schedule time with me. I think I'm pretty booked up. We've got some travel going on, and of course, the holidays here in the near term. So jump on that, book time with me, and we can work on what's right for you specifically. I should say, nothing on this webinar is financial advice. Financial advice is specific to you and your situation. Don't follow rules of thumb. You are not average. Nobody's average. This is not financial advice. Financial advice is what we do one-on-one. I have all of these other webinars that I've done in the past. I've got recordings of them. Happy to share. If you want to hit me up by email, I can do that. Here's my email address right here, joe@bestfinlife.com. I've got other resources, podcast, blog, some educational videos. Our next webinar will be December 2nd. It's called How to Manage Your RSUs. So we just talked about ESPP this month. Next month, we're going to talk about RSUs.